Want to borrow for your business? In this video, we will explore the impacts of bank debt on cash flow and tax obligations. By understanding how debt can reduce available cash for owners and alter tax implications, you'll be better equipped to make informed financial decisions for your business. Here's an example. Alpha has sales of $390,000 and net profit after tax of $112,500. This amount is entirely available to the owner for drawings or dividends. For simplicity, we've assumed a tax rate of 25%. How do their financial accounts change when Alpha Limited starts borrowing money? Let's see an example in action. Alpha approaches their local bank to apply for a loan of $200,000 to open a retail store to sell their products. $200,000 will be used to fund the building's fit out, upfront expenses, and buy additional stock. Now let's run the numbers. Repayments amounts depend on the period chosen. A 7-year term is often ideal as it aligns with a typical economic cycle. At an interest rate of 10% per annum, a $200,000 loan would require annual repayments of $39,842 or $3,320 per month, including both principal and interest. Let's see what happens to Alpha's profit and loss statement after they've taken on the new debt. This example doesn't include any earnings from the new store yet. A new line item for interest totaling $19,064 has decreased profit, tax payable, and net profit after tax. There is also a gap between net profit after tax and the amount available to the owner, as the principal repayment of the loan is recorded on the balance sheet, not the profit and loss statement. You'll need to pay the principal from cash flow before making any payments to owners. The owner's cash flow has decreased by $35,077 as a result of taking on the debt. This figure is less than the total repayments of $39,842 because only the interest is recorded as a tax-deductible expense. The business must forecast that the new retail store generates a net profit after tax of over $35,077 to maintain positive cash flow. The owner should also be ready to lower personal withdrawals if the store's performance falls short. Finally, it's crucial to recognise that there may be additional sources or uses of cash during the period, particularly changes to the balance sheet that we've not addressed here. For simplicity, we assume that all other factors remain constant.